Welcome, everyone, to this wealthmanagement.com Fast Chat. I'm David Armstrong, the editor of wealthmanagement.com. Joining me today is Mark Premselar, the Senior Managing Director of Structured Solutions at Case Group. Mark, thanks for joining us.
David, thank you so much. Pleasure to be on.
So today we're talking about structured notes. First of all, for financial advisors out there who might not have an idea, just give us your definition. What is a structured note?
Thanks, David. Structured notes, technically speaking, are a type of fixed income instrument or a bond backed by some of the largest banks and financial institutions across the globe. Unlike traditional bonds, however, the payout of structured notes can be tied to many different types of market-linked securities, like the S&P 500, a basket of ETFs, Apple stock, or even the price of oil. From a financial advisor's perspective, a structured note can be thought of as a highly customized investment that can be tailored to reflect a certain view of the market, a sector, or as an overall complement to their portfolio.
That's great. When advisors are thinking about these things, which asset allocation bucket should they think about putting structured notes under?
Yeah, it's a great question. I think one of the biggest misnomers about structured notes is that they're an asset class themselves. Rather, they're an implementation to the traditional asset classes across a portfolio. For example, if you think of a large cap mutual fund would be an implementation for an advisor's equities bucket. And structured notes are just like that. As we talked about earlier, structured notes are highly customizable and can be linked to many different underlyings. So if we take, for example, a structured note that's tied to the Russell 2000 that has a buffer on the downside, right? We could easily put that into the small cap equities bucket or the US equities bucket, right? Conversely, if we look at a more yield-oriented structure that could pay roughly a fixed or contingent coupon so long a basket of indices don't decline beyond a certain level, right? That could be thought of as more of a yield-oriented instrument that could be, in the same bucket under the alternatives trading strategies like private real estate or direct lending or private credit, right? So when you think about the usage of structured notes, don't think of them as an asset class, right? But think about what they're trying to accomplish in a portfolio and what the underlying asset is when you group it in your overall asset allocation.
So why is the market ready now for structured notes? Why should advisors consider them now?
I think when you consider structured notes, there's never a why now or why is the market primed at this very moment? Because I think over the past 12, 13 years, when you look at the bull market that we've been in, there's been many investors that have missed the ride or have worried about market timing and thus missed big chunky returns in the marketplace. But because structured notes, many of them have downside protection, it really helps the investor psychology of market timing or mistiming, because even if they don't feel like they're getting it at the right time, the downside protection can help them assuage fears about making a big mistake. So that's one. Number two is, as I mentioned earlier, when markets decrease, there's dislocations in the market. Not only does the volatility help the pricing, but also you're getting a better market entry point. So when there is volatility, when there is dislocation and turbulence in the marketplace, structured notes could be an actionable idea. And then lastly is just the nature of structured notes, where they're designed to help you stay the course and not worry about the intermittent ride of the investment, as many of them are measured point to point from a return perspective. So even though structured notes, there is generally liquidity for these in the secondary market, the terms that you get really will be stated if you hold to maturity.
Yeah, that long-term thinking is good for advisors and clients. What is the biggest hurdle that advisors have to overcome when they start allocating to structured notes?
Yeah, it's a good question. And when I think about it, there's really two hurdles that advisors are facing when allocating to structured notes. The first is education, right? So if this is a new concept for you, first you have to learn it and then position it to your clients. So you really want to make sure that you learn it well, and that you're confident in the asset class. And there's a lot of resources out there for you that Case offers, and platforms like our learning platform, Case IQ, can really help advisors sharpen up and become strong in the asset class. And that's one. And number two is sort of I think the bigger hurdle is that structured notes, for many cases, for advisors that are using them consistently in their portfolios, is actually the only thing in their portfolio, only investment that they may manage themselves. So when you think about how they allocate to equities, fixed income, even alternatives, a lot of that, or most of that, is outsourced investment management to third-party managers. But in structured notes, they end up managing the portfolios themselves, and that can become a hurdle. But I think, as we'll talk about a little bit later, as the structured note industry really matures and advances, there's a lot of tools out there.
Yeah, I did want to ask you about that, about the growth of structured notes, and particularly in the independent wealth management space among RIAs and independent wealth managers. Can you talk a little bit about that?
Sure. So the structured notes industry last year for all structured notes and market linked investments was about $100 billion in issuance, which is a pretty good number, up about 30% from the previous year. And over the past 5 years, that number has more than doubled. Still, that's a fraction of the size of the overall global business. The business is increasing. And I think one of the biggest drivers of that is the increase of adoption in the independent space. I think one, you sort of have the macro trend in the wealth management industry that firms are going independent, and therefore firms are having to adopt, the same tools that they either used or didn't use when they were at their previous firms at a wirehouse or private banking firm. But they have to adopt those tools to compete, right? They have to gain their wallet share. They have to show the same competitive landscape and moat that to offer the same tools. So I think that's really forcing people to be open and to incorporate this as an asset class. And finally, it's really the modernization and the maturity of the structured notes industry, especially for independent advisors who, prior to the last 3 to 4 years, really didn't have many tools for them to access structured notes aside from just making the initial investment. But again, the educational resources, the human capital, the technology like firms like Case and others offer really has helped the space mature and really let independent advisors compete and utilize structured notes as a real staple in their portfolio.
Yeah, there certainly is a lot more information out there, Case IQ being a good resource for that. A lot of information for advisors who want to learn more. This has been a great fast chat, Mark. Thanks very much. I appreciate it. Mark Premselar, Senior Managing Director of Structured Solutions at the Case Group.
Thanks so much, David. It's fantastic.